This is the flagship product of GIG and specifically designed to accelerate families in getting out of debt and to invest into income generating assets. This fund is put together from the interest-free deposits received from members, and in turn they can borrow against this fund up to 3 times their deposit, interest-free. There is a further benefit in that the repayment period on future loans can increase up to 7 years once a member has been an active member of the loaning share funds for 7 years or more. Although there are different membership options, every paid member must pay a once-off 250 Rand. Of this amount, 100 Rand is kept as a mandatory share, which allow the member to become a shareholder in GIG CFI and share in future profits. The balance of 250, the 150, is the initial cost to open a banking profile for the member on the banking software. All additional money that the member deposits into his loaning share account is treated as voluntary shareholders' capital. It is against this capital that the member can start to make future interest-free loans, which he then uses to pay off high-interest debt like credit cards and overdrafts, and later invests into income-generating assets. The benefits and possible application of the loaning share product will be discussed in greater detail in future sessions. Through the loaning share product, the member effectively creates for himself and his family a funding mechanism that liberates him from the current onerous and costly lending mechanisms of retail banks and becomes an asset that he can bequeath to his children's children. The general rules on how to qualify and use the loaning share product is as follows. Be an active contributor for at least 12 months. For the first loan, the qualifying amount against which the member can leverage his first loan is based on the following formula. Either 3 times the closing balance on the loaning share deposit or 5.5 times the average availability of funds, whichever is the smallest. For future loans, the qualifying amount against which the member can leverage his future loans is based on the following table. This table shows that the full deposit history is considered in calculating a member's base amount. 75% weight is given to the last 2 years, with 25% of the weight given to earlier years. These formulas have been developed to ensure a fairness factor whereby a member can benefit from the fund in direct proportion to how his own funds were made available to other members. The fairness formula in year 1 is best illustrated in the following examples. In example A, we're looking at member A who saves a regular amount of 1,000 Rand per month. So for 12 months, his balance steadily grows to 12,000 at the end of the year. To calculate the average availability of funds, we look at the cumulative availability over the last 12 months. In month 1, it was only 1,000 Rand. The total deposit balance at the end of month 2 is 2,000. We add it to the first 1,000, and that gives us a cumulative availability of 3,000. And we repeat that formula until we get to month 12, when the cumulative availability stood at 78,000 Rand. We then divide the 78,000 by 12 to give us what is the average availability of funds during the year, and that gives us an amount of 6,500 Rand. If we now apply the formula on the average formula of 6,500 times 5.5, we arrive at a potential loan amount of 35,750. Or if we look at the closing balance of 12,000 times 3, it gives us 36,000. So there's a minor difference of 250 Rand. In this case, the loan amount this person will qualify for will be the full 36,000 Rand. In example B, member B saves 100 Rand per month for 11 months, and in month 12 he adds 1,900 Rand to make up 12,000 Rand. If we now look at the table, it shows that the deposit balance grew from 100 Rand to 200 Rand to 300 Rand all the way up to month 11 when he had 1,100 in the bank. Then in month 12 he adds 1,900 and it brings his total balance up to 12,000. But now let's look at the cumulative availability. So the 100 plus the 200 gives us 300. The 300 plus the 300 gives us 600. So when we get to month 11, his cumulative availability stood at 6,600. The 1,900 he deposits in month 12 now puts his total to 12,000, which if we add it to 6,600 gives him 18,600. The average availability of funds is then the 18,600 divided by 12, which gives us 1,550. Now let's apply the formulas. The average formula is 1,550 times 5.5, which gives us 8,525. Whereas if we just had the 3 times formula of the closing balance, it would have given us 36,000. So in the case of member B, the loan amount that he qualifies for based on his savings history is the least of the two options, which is 8,525. Example C shows how the fairness factor is applied after year 2. Now the rules that is applied is that the back office gets the closing amount of the member's loan share account at the end of each year. They then apply the corresponding percentage weight to the amount of each year. They add up the total, and the total gives the base amount against which the member qualifies to borrow up to 3 times. Member C has been a CFI member for 3 years and wants to take out a loaning share loan 3 times his base amount. He has saved 100 Rand per month for the first 2 years, and in year 3 he pushed it up to 1,000 Rand per month. Now let's do the calculation. The amount saved in year 1 is 1,200 times the 25% weight gives us 300 Rand. His total amount saved at the end of year 2 is the first year's 1,200 plus the new 1,200. He now stands at 2,400. We apply the weight of 25% and that gives us 600. Then he adds 12,000 to the 2,400 to gives him a balance of 14,400 at the end of year 3. We apply the weight of 50%, that gives us 7,200. If we now add up the 300 plus the 600 plus the 7,200, it gives us the base amount on which he qualifies for a 3 times loan of 8,100. So the potential loan amount, subject to affordability, that member C can get from GIG is then 24,300.